Hey guys, so we still have to cover part C on IT governance of chapter 1, Business Information System Strategy and Governance. I'm gonna be honest, it's not the most exciting part of this chapter, but it is a very important and essential part in today's business and IT environment. Let's kick off with the overview. First, we're gonna start with discussing corporate governance. Next, we will elaborate on the principle of internal control, and we will also discuss governance frameworks to guarantee this. Then we're going to move over to information systems governance, and we're going to discuss the very important COBIT standard, and we're going to finish off with a conclusion. Let's kick off with the introduction on corporate governance. Well, where did the idea of corporate governance emanate from? The idea of corporate governance emanated from the various scandals that we witnessed in business, right? The first important scandal was the Enron scandal. Enron was basically a huge energy company whose leadership fooled regulators with fake holdings to hide its huge amount of debt from its shareholders. Basically, what its leadership wanted to do was it wanted to brush up its image to show that it has good and solid financial solvency, such that it could hide this huge amount of debt from its shareholders. Actually, this is something that you can do during a very limited amount of time, but at some point, the bubble will obviously burst, which led to Enron filing for bankruptcy in 2001. And a very similar case occurred to Parmalat, which was an Italian dairy and food corporation that used a fake 4 billion euro bank account that was held on the Cayman Islands, again, to brush up its image to show to its shareholders that it had good financial solvency. But actually, this only lasted a certain amount of time until again the bubble burst and Parmalat had to file for bankruptcy in 2003. And there's plenty of examples. There's Societe Generale, which is the French bank and insurance firm that had in 2008 one rock trader. His name was Jerome Kirvel, if I remember well. And the bank lost about 4.9 billion of euro because of this one single rock trader. So what actually happened there is that there was this single person that had too much power. He was able to close very important business deals. In this case, it was just trading stocks, but he was very powerful. He could make deals for huge amounts of money, such that if one of those deals went bad, then obviously it exposed the firm to a huge amount of risk, such that Societe Generale faced serious trouble in 2008. They did not go bankrupt, but they had to cover up a huge amount of debt because of this one single rock trader. And then obviously we had the credit crisis. You still remember in 2008, where I mean the credit crisis was taking place because there were so many complex financial products that were being created. At that time, they were called asset-backed securities or special purpose vehicles. And basically, the idea was that these were black box financial instruments that collected bad debt and then which were sold at too high prices, such that at some point also the bubble burst, which led to the credit crisis and a huge housing crisis in the US, such that many people, many Americans in the US, their mortgage, the amount they had to pay off on their mortgage was a lot more, and the value of their mortgage was a lot more actually than the value of their house because of this real estate bubble burst. And you see what actually happens there is that um, people or decision makers, managers, or people that operate across various units in a business, they have too much power. And because they have too much power, they can engage into fraudulent activities. They can engage into rogue decision making, such that at the end of the day, it's going to cost the company a huge amount of money. It may lead up to bankruptcy, and it can even have a huge societal cost as well. Think about the credit crisis in 2008 that actually caused huge social drama as well with people whose savings of money, whose savings money was no longer available, was essentially lost, etc. So given all these scandals, given all these fraudulent and malicious practices that took place in a business environment, there was a need for internal control and governance to make sure that these things were never going to happen again. So, what is the idea of corporate governance? And here I took a definition from Wikipedia, right? We use Wikipedia as well, and there's quite good information on Wikipedia. And Wikipedia defines corporate governance as the collection of mechanisms, processes, and relations used by various parties, we also call those stakeholders, to control and to operate a corporation. To control and operate a corporation in a trustworthy way, such that um, fraud or malicious practices are mitigated or actually eliminated as much as possible. That's the goal you want to achieve with corporate governance, or more specifically, what you want to do is you want to regulate your risk. You want to make sure that there's not too much power in the hands of only one or a few people without any control mechanisms, without seeing whether they are conducting proper business operations, whether they are conducting proper trade deals, etc. So you want to regulate that risk so that you can reduce the opportunity for corruption and fraud practices to occur. And the way you're going to do that is you're going to do that by maintaining legal and ethical standards. Very important, obviously, is that those legal and ethical standards have to be clearly articulated. That's why we see nowadays so many legal and ethical guidelines. Think about GDPR, for example, for privacy, but think about other guidelines as well to ensure that when you work in a business unit across the various levels of decision making, from the strategic to the tactical to the operational region level, that you adhere to those legal and ethical standards. That's the idea of corporate governance. And what's really very important is that corporate governance is not only a management thing, so it's not only a C-level thing for C-level executives like the chief executive officer, the chief risk officer, the chief financial officer, etc. But corporate governance should be a practice which is embedded throughout the whole firm, throughout the whole enterprise. And the idea is to assign responsibilities to the different stakeholders. And the different stakeholders are all the parties that a company is basically related to throughout its various business units, internal but also external. So we have the board of directors, which is one type of stakeholder. We have managers across the different levels, strategic, tactical, operational. Obviously, we have the employees and trade unions, which are also a very important stakeholder. We have the shareholders. The shareholders are essentially the owners of the firm, right? They invested in the shares, so they took the risk because they believed in the concept of the firm. So they are the owners of the firm. And then we also have the auditors. And in the world of corporate governance, within the setting of corporate governance, these auditors will play a crucial role, as those will be the stakeholders that will be on the lookout for malicious or fraudulent practice. They will audit your firm, look at all your business activities, and see whether they are conducted in a proper way. Obviously, a proper way is something that should be defined. Now, this whole idea of corporate governance is essentially complicated by a very important problem, which is the principal agent problem, whereby you have conflicting interests between shareholders, which we refer to as a principal, and a management, which we refer to as an agent, right? A shareholder, what is a shareholder looking for? Well, a shareholder wants to um, make sure that the share price increases, or wants to make sure that the company pays high dividends. The shareholder wants return on his or her investment, either by an increasing share or stock price, or either by having high dividends being paid out. And those goals should obviously be aligned with the goals of the management, the agent. But this is not always the case, because C-level executives sometimes, in certain settings, may not be that much interested by maximizing shareholder value, but they may be more interested in, for example, their own careers, right? And making sure that they earn a lot of money by focusing on their own careers. That means that you have some kind of, in certain settings, that you could have a misalignment between the shareholder objectives and the management objectives. And the idea of corporate governance and also of IS governance, which we will elaborate later on, will be to align both in a more optimal way. The principal agents problem. Okay, now because of all these huge scandals that took place, like with Societe Generale, like with Enron, like with Parmalat, like with the credit crisis, there were two US senators called Sarbanes and Oxley that came up with an act in 2002 to ensure good corporate governance, to make sure that scandals, fraudulent practices, etc., were minimized. The Sarbanes-Oxley Act is often referred to as the SOX Act. So it was filed and to the U.S. Senate. It was approved by the U.S. Senate in 2002, and it was signed by then U.S. President George Bush um, to ensure that all firms complied with the basic principles of corporate governance. And the idea was to protect the shareholders and public, so society as a whole, from accounting errors and fraud. Now, look at this very important. Look at this very carefully. It says accounting errors and fraud. There's a difference between an error and a fraud. A fraud is with a malicious intent, right? A fraud means that there's some kind of criminal, a fraudster, that has a malicious intent. An error is not always with malicious intent. We all make errors, right? And the goals of the SOX Act was to protect the shareholders and the public not only from fraud, but also from accounting errors, such that the accounting numbers, the figures that were being presented to the shareholders, but to the public as well, were always fair, transparent, and a trustworthy representation of reality. The ultimate aim was obviously to improve the accuracy of corporate disclosure of all numbers that related to the functioning of the firm, right? Accounting numbers, non-accounting numbers, marketing information, stock price information, etc. Everything should be accurate and transparently communicated such that shareholders and the public are well informed at all possible times. Now, as I said, the SOX or the Sarbanes-Oxley Act was a US federal law, and it's still in place nowadays, right? Setting new standards for publicly traded firms. So firms which are stock listed on the NASDAQ or on the New York Stock Exchange, etc. Um, Actually, what this law also specified is that the top management must individually certify the accuracy of the financial information. So a lot of responsibility was given by the top management to the top management. They must be, they must guarantee that any information they provide to the shareholders, to the public at all times is a trustworthy and accurate representation of the true status of the firm at that one particular moment in time. And actually, what was also very important is that the SOX Act included severe penalties for fraudulent activities. So if you maliciously represent information so as to boost the image of the firm, but in an untrustworthy way, in an incorrect way, then penalties were attached to that. Also, SOX included an increased independence of external auditors. Right now, we have a lot of firms. Think about the consulting firms like Ernst EY, think about KPMG, think about Accenture, think about Deloitte, etc., who have huge teams of auditors that will come on site with firms and are going to audit all their business activities, all the financial numbers they report to make sure that the business is fully compliant with the Sarbanes-Oxley or the SOX Act. So it's a huge amount of auditing business that is going on there to make sure that companies at all time comply with this. And what's very important, obviously, is that SOX also regulates those audit firms like KPMG, EY, like Deloitte and Accenture that audit companies that must comply with SOX. So the SOX counts not only for the company, but also for the auditing company to make sure that this auditing is always done in a trustworthy way, in a correct and accurate way. As I said, SOX included some severe penalties for fraudulent activities, and just to give you some example penalties, for example, if a manager has deliberately submitted an inaccurate certification, so you can consider this as a type of fraud because the intent was there, hence the word deliberately. If a manager has deliberately submitted some inaccurate certification, then the corporate fine can go up to 5 million US dollars with up to 20 years in prison for the individual. So you see that there's a lot of pressure which is being put on the individual, on the manager, on the C-level executives to make sure that all information that they send out to any stakeholder is always accurate and correct. Another example penalty that was also included in the Sarbanes-Oxley Act was that accidental miscertification or non-submission. Accidental means that the intent is not necessarily malicious, right? Could be something that is forgotten. But even there, um, there's a fine, there's a corporate fine of up to 1 million US dollars, and the person that is responsible to it can actually end up in prison for 10 years. Obviously, these are mechanisms which are used to indicate the importance of trustworthy reporting to make sure that managers are always reporting things as they should be and not misrepresenting information as was done in the cases that I elaborated on previously. Okay, the Sarbanes-Oxley Act, like every act, has various sections, right? And there's a very important section 404, and this deals with internal control. And it's going to assess the internal control, the facilities that the company has built in to ensure internal control across all its activities, strategic, tactical, and operational. And it basically says that all financial information should be should be tracked. You should be able to track all financial information to its origin. We call that lineage. So if financial numbers are reported, you think about a balance sheet or a P&L statement that reports profitability numbers, that reports solvency and liquidity numbers. All the numbers that are being reported should be one should be able to track these numbers back to their very origin, to their starting numbers from which they were calculated from. This is one mechanism to ensure internal control and to make sure that no errors occur or no fraudulent activities can take place to misrepresent numbers. And it's the management who is responsible for establishing and maintaining an adequate internal control structure and various procedures for financial reporting, for trustworthy financial reporting, for accurate and correct financial reporting. They should not only develop or establish and maintain those procedures, but they should also document, test, and maintain those controls. Right? It's also very important that they're appropriately documented and tested. Right? This is especially relevant for the external auditing firms, such that they can start off with a well-specified set of documents clearly outlining the various procedures of internal control that the company is adopting to comply with the SOX or Sarbanes-Oxley Act. Internal control is a very important concept within Sarbanes-Oxley, as I mentioned, and it's actually a process affected by an entity or a firm's board of directors or management and other personnel. Really important. As I said, the whole concept of internal control stretches out across the various levels of decision making in a firm, and it's designed to provide reasonable assurance regarding the achievements of objectives. Objectives relating to the effectiveness and efficiency of the operations, the reliability of the financial reporting, and the compliance with applicable laws and regulations. And obviously, this is a very daunting and challenging task. The reason being that these laws and regulations basically change on an ongoing basis. So corporate governance or internal control is not a single shot activity. It's not in the sense that you have to do it once and then you're done. It's basically an ongoing activity that keeps the firm busy to ensure that its reliability of the financial reporting, its compliance with new laws and regulations, and to ensure the effectiveness and efficiency of its operations. But a key question is, How do you realize this? How do you accomplish this? And there's various standards that have been suggested, and one of the most important ones is the COSO Internal Control Integrated Framework Standard. COSO is a standard for ensuring corporate governance or SOX compliance and was developed by the Committee of Sponsoring Organizations, hence the name COSO, of the Treadway Commission, which is like a commission that consists out of various parties that you'll see listed there. You don't have to remember all these names, by the way. Basically, it's nowadays, if you look at the business environment nowadays, it's the most important internal control framework for obtaining SOX compliance. If you look at the cube at the bottom, you will see that it has various components. So it has a control environment, risk assessment, it includes control activities, information and communication activities, and monitoring activities. And these are being stretched out across various objectives, operations, reporting, and compliance, but also across the firm-wide enterprise structure, across entity levels, divisions, operating units, and function. So internal control and corporate governance is essentially a firm-wide activity. Everybody in the firm should have heard of it and should know what to do to ensure that the appropriate internal control mechanisms are put in place to, as such, comply with the basic principles and ideas of corporate governance. The most recent version of COSO was developed in 2013, hence the name COSO 13, and you can see the 5 components listed again to the left, which are being spread out across 17 principles. So if you look at the control environment component, for example, you can see that it comes with 5 principles. The first one states commitment to integrity and ethical values. Obviously, what's really very important is that this is there's always a subjective element to when it comes to integrity and ethical values. So if I would, I mean, you will often find that people share some common ethical values, but it's not always perfectly aligned. So it's sometimes a very thin line you're walking on. Second principle states the independent board of directors oversight. Independent is very important because dependency creates a weakness, since it may lead up to fraudulent or malicious practices. There should be structures, reporting lines, authorities, and responsibilities. Those should be clearly outlined. We should attract, develop, and retain competent people. Again, a little bit of a vague term, but it is an important goal that is being aimed for there. And people should be held accountable for internal control. And we have similar principles. I'm not gonna enumerate all of them, but we have similar principles for the risk assessment component, for the control activities component, for the information communication component, and for the monitoring activities. And actually, each of these further principles is further disentangled into points of focus. You can see, for example, for the first principle that we discussed previously, which was commitment to integrity and ethical values, that we have 4 points of focus. Means the first one says set the tone at the top. Establish standards of conduct as the second point of focus. Evaluate adherence to standards of conduct and then address deviations in a timely manner. 4 very important points of focus that are important to the firm to comply with the COSO framework and as such to SOX and the ideas of corporate governance. And for each of the 17 principles on my previous slide, you have these various points of focus. COSO's 2013 internal control or integrated framework is one of the most firm-wide, industry-wide frameworks for ensuring SOX compliance. And what's really very important, it's a business framework, so it's not IT specific. Same holds with for SOX. SOX is a legislation. It's not an IT framework. It's not a set of IT guidelines. Just as with COSO, it's just not IT specific. But obviously, many of these internal controls, which we need to ensure transparency, to ensure that fraud and malicious practices are minimized, will be realized by means of IT mechanisms. So IT will form a cornerstone for compliance, for reporting, for risk management in many organizations to ensure compliance with COSO, to ensure compliance with the SOX framework, and as such, ensure good governance. Note that this is essentially big business for consulting firms, like, as I mentioned before, for EY, KPMG, Accenture, etc. This is big business because they all have huge business units of people that go on site with other firms to ensure that SOX compliance is there, COSO compliance is there, and so on. And many of these firms also rely on information systems or IT governance frameworks, such as COBIT, which we will elaborate further on. Essentially, what is IS governance? Well, IS governance is the decision power or the organizational capacity executed or exercised by the board of directors, or the executive management and IT management, again across the various levels of decision making, to ensure or control formulation and implementation of IT strategy, and very important, ensure alignment of business and IT. IT and business should be aligned. IT should support business, and business should also identify new opportunities for IT technology to create new business strategies, for example. So the primary responsibility for IS governance lies with the board of directors. They should outline a strategy, like an IS strategy as well, that ensures that business and IT are always fully aligned. And what are the IS governance mechanisms that we can then rely on to ensure that this is fully established? Well, there's structures. So every C-level or board of directors should include a chief information officer or CIO. And nowadays we see various types of other profiles popping up in these executive boards, which are somewhat IS related, like a chief data officer or CDO. Some companies have a chief data officer. Some companies also have a chief analytics officer. Analytics, which is essentially an IS technology that many firms use at the strategic level to compete with other firms. Hence, the importance thereof. Because of the importance thereof, they also include a chief analytics officer in their board, or a chief digital officer, sometimes also referred to. There should be IT steering committees. IT steering committees that will help you manage your IT projects, that make sure that your IT projects are appropriately managed, well framed, that we have the right resources for them, that they are meeting the right deadlines, etc. Another ITIS governance mechanisms are the processes that are put in place, like portfolio management. How do we manage our portfolio of IT projects? How do we select them? How do we prioritize our information systems projects? That is all part of the processes IS governance mechanism. Just like SLAs, service level agreements, like if you have a certain type of IS process that you're developing, and that you're implementing afterwards, there could be certain service levels that should be guaranteed in terms of, think about in terms of the number of transactions that should be processed per unit of time, in terms of the response time, in terms of the compliance with privacy standards, etc. Another very important IS governance mechanisms is the relational mechanism, like job rotation is a very nice one. To ensure business IT alignment, what you see certain companies doing is to rotate people between the IS and the business department, right? So an IS person is being put in a business unit and a business person is being put in an IS department. And by creating that job rotation, basically what you're ensuring is that you're ensuring that both departments are always properly aligned, understand each other, such that this premise of business IT alignment can be nicely fulfilled and satisfied. Co-location is another one, right? It's also a relational mechanism where you're going to put people from the business next to people from the IT department or the IS department to make sure that there's swift and smooth communication such that both can jointly tackle the business problems, but also identify new business opportunities because of emerging IT technologies, for example. Cross-training is another one. That means that you're going to put someone from the business and someone from the IS, or more members, more people together, train them to make sure that the business and the IT are always properly aligned. So you see, you have these three IS governance mechanisms: structures, processes, and relational mechanisms, which are very important. Here you can see this visualized again. We start from IS governance, and the ultimate aim of IS governance is to achieve business IT alignment such that we can optimize our organizational performance, such that we can create value for the various stakeholders involved, and such that we do that in a trustworthy way, in a SOX compliant way, guaranteeing all the basic principles of corporate governance. One standard to guarantee this is the COBIT standard, and it's a business framework for governance and management of enterprise IT, and was developed by ISACA, and you can see the website indicated there, already in 1996, so quite a while ago. And ISACA is actually an Information Systems Audit and Control Association. So it's a controlling association that is going to look at your IT systems and make sure that your IT systems are always fully aligned with your business objectives, that there's no room for errors, that there's no room for fraud, etc., etc. That's very important. What's also very important is that this ISACA organization is an international professional association for IT governance and audit, so it's not scientifically grounded. The principles that they came up with to support IS governance were based upon years of experience, were based upon good practices and years of experience, bad and good experiences. Think about the bad experiences I listed at the start of this chapter, to ensure that business and IT are properly managed, properly aligned. And this one, the COBIT standard, especially looks at the IT component. It's a certification organization. ISACA, again, consists out of several sub-organizations, so it issues certificates, all IT related. And throughout the years, it kind of came up with various standards. The COBIT 5 standard was introduced in 2012, and the most recent one, COBIT 2019, was obviously established in 2019. It's a very important standard because it's used by more than 60% of the firms worldwide, which is quite a lot. In fact, firms use this to show off to their shareholders that they're good at IS governance, that they're good at corporate governance, at internal control, such that all the things that they report, the representation that they give to the outside world, to the stakeholders, to the public, to investors, etc., is trustworthy, is accurate, and not malicious or whatever. Okay. COBIT is essentially a set of tools. It's a framework that consists of a set of tools that information technology is working effectively so that it's achieving the goals that it's meant to achieve, and it generates value. Generates value for the business, generates value for the shareholders, for the community, and society as a whole. So it tries to introduce a common language to communicate goals, objectives, and expected results to all stakeholders. And by introducing this common language, you facilitate communication. And the way the standard was built is by integrating industry standards and good practices from years of experience in strategic alignment of IT with business goals, in value delivery of services and new projects, in risk, resource, and performance management. As I said, it's used by more than 60% of the firms worldwide. And in fact, COBIT is one of the most widely accepted standards for demonstrating SOX, Sarbanes-Oxley compliance, for heavily IT-centered organizations. So it will include many of those control mechanisms, those internal control mechanisms, but from an IT perspective, which pretty much relates to Section 404 of the SOX Act on internal control structure, remember. Um, ISACA recently conducted a survey just to see what firms perceive as the top benefits of COBIT, of their implementation of COBIT. And here you can see the top 4 benefits that they considered. First of all, IT integration. So one benefit that was perceived by many firms implementing COBIT is that all their IT processes were more integrated. Oftentimes, you will see firms losing value, losing business value, losing profit because IT processes are not well integrated but work as stovepipe isolated process. So IT integration is really a very important benefit as it was perceived by many organizations implementing COBIT. They also perceived improved risk management in terms of qualifying the risks, which means identifying the risks, but also quantifying the risk. At the end of the day, you also want to quantify the risk to know whether there's some expected or unexpected losses that you may be exposed to for which you have to set aside provisions, for example. Another benefit was discovery of gaps in security. Nowadays, we hear a lot of all these cybersecurity attacks, and I think cybersecurity will be a very important challenge for many firms in the next few years. And also, thanks to COBIT, many firms were able to discover gaps in security, like cybersecurity, such that such that they could come up with remedial actions. And finally, another benefit of COBIT is that it creates a framework that provides more visibility to the board of directors. And that's very important, such that IT becomes more visible to the board of directors, because IT should be actually across enterprise technology, across enterprise tool. It should be embedded in the DNA of an enterprise across all levels of decision making, from the bottom level, tactical level, from the bottom level, the operational level, up to the tactical, up to the strategic level, up to the board of directors. Here you can see the 6 governance principles of COBIT, and essentially these governance principles exist to ensure that the stakeholder needs, like the shareholders, like the employees, like the customers, like the suppliers, are evaluated and agreed on based on certain preset out enterprise objectives to set direction by means of prioritization and decision making, and to monitor performance and compliance against the set direction and objectives. And you can see that the 6 governance principles are that we should provide stakeholder value, and obviously these are two vague concepts that should be properly defined. Who are my stakeholders? What type of value should I create? We should adopt a holistic approach. That means that we should embed all relevant activities that the firm is conducting. It should be holistic. It should be comprehensive is a good synonym for that. We should have a dynamic governance system, both internally and externally, because the challenges a firm is exposed to internally, but also externally because of new legislations, because of new ethical standards, because of new guidelines, because of new corporate governance principles, etc. All of these should be followed up closely by means of a dynamic governance system. The fourth principle is a very important one because it states that the governance should be distinct from the management. That's really important. They're considered to be two distinct activities. A fifth principle is an obvious one. And the governance should be tailored to the enterprise needs. It's quite obvious, but the COBIT committee insisted on also formulating it as a principle because it considered it as very important. And we should aim for an end-to-end governance system, which kind of covers the entire spectrum of activities that the enterprise covers. So this end-to-end corporate governance system, the end-to-end governance system is really an important and essential governance principle of COBIT. COBIT is an integrated framework in the sense that it integrates various other types of frameworks and IT-related standards that can be combined with COBIT. And here you can see some of them like TOGAF, like Prince2, PMBOK, various ISO, International Standards Organization, frameworks, CMMI, etc. You should not learn all these by heart. Obviously, you can see some more listed here, but COBIT kind of is a framework that is an overarching framework that can be combined with any of these other IT standards. Like here you can see Prince2, which stands for Projects in Controlled Environment, PMBOK, Project Management Body of Knowledge, etc., which all relate to conducting IS projects and management and the alignment of IS in business in the most optimal way. Okay, COBIT has various design factors, and these are factors that can influence the design of an enterprise's governance system and position it for success in the use of information and technology. Here you can see the design factors listed. So we have enterprise strategy, enterprise goals, the risk profile. Risk is a very important concept in business environments nowadays, as firms want to adequately qualify and quantify the risk. IT-related issues, the threat landscape, what threats you're exposed to. This could be competitor threats. These could be other types of threats, maybe threats from your customers as well. The compliance requirements, which are obviously, this is an ongoing effort because we have standards that are being developed on an ongoing basis. the role of IT, the sourcing model for IT. Where do we get the sources for? Do we use where do we get our hardware sources for? Where do we get our software sources for, or development sources? Are we going to do outsourcing? Yes or no? The IT implementation methods is another design factor. Technology adoption strategy. What strategy are we aiming for when adopting new types of IT technology? And then enterprise size, the size of the enterprise, considering that is another very important design factor. COBIT has governance objectives and management objectives. And here you can see again a separation. And that's a very important thing here is that we separate the governance objectives from the management objectives, right? And each of them is organized into particular types of domains, right? So the governance objectives, and note that an objective is the same as a process because essentially COBIT introduces about 40 processes, right? 40 processes, right? Either government objectives, or management objectives that these processes aim for. So COBIT consists out of 40 governance objectives and management objectives combined, which are all realized by means of processes. And the governance objectives are typically organized, the governance and management objectives are organized in domains, right? So governance for our governance objectives, we have EDM, evaluate, direct, and monitor. These are key governance objectives. The management objectives come with four domains: APO, align, plan, and organize; BAI, build, acquire, and implement; DSS, deliver service and support; and MEA, monitor, evaluate, and assess. And each of these comes with processes. And here you can see the various processes. Here you can see those 40 processes that realize these governance objectives and these management objectives, right? So um, note that one objective here corresponds to one process. So let's look at the first governance objectives process or objective is EDM 01, ensured governance framework setting and maintenance. And then we have four more governance objectives or processes, and likewise for the management objectives, right? So we have about 35 management objectives and processes. Let's have a look at one just to show you how this looks like in the COBIT standard. And I can tell you that the COBIT standard is a very thick document. It's a very big PDF whereby each of these objectives, each of these processes is clearly outlined in terms of its various key characteristics. And here you can see the first governance objectives, which was ensured governance framework setting and maintenance. And you can see the domain that evaluate, direct, and monitor just above. Remember that the governance objectives correspond to one domain: evaluate, direct, and monitor. You can see a description of this objective or process. You can see the purpose, and then you can see that this particular governance objective supports the achievement of a set of primary enterprise and alignment goals. Enterprise goals that you see listed there, alignment goals that you also see listed there, to make sure that the alignment between business and IT is fully satisfied. And then you can see metrics, example metrics for these enterprise goals and example metrics for these alignment goals. COBIT also heavily relies on a Rocky matrix or charts. Rocky stands for responsible, accountable, consulted, and informed. And this is a tool that outlines who is responsible for a certain business process or business activity, who could be held accountable for a certain business process or business activity, who should be consulted about a certain business process or activity, and who should be informed. So it kind of lays out the responsibilities of the various parties whom you can see listed in the columns, like the board, the chief executive officer, the chief financial officer, chief operating officer, and so on. And that should then be contrasted in a matrix or chart against the various business activities or processes that you can see in the roles, whereby in each cell we say who should be responsible for it, who should be accountable for it, who should be consulted about it, and who should be informed about it. COBIT also comes with a process maturity or a process capability level that kind of indicates how sophisticated your processes are, because it's not because you design a process that once you design it, it's fully operational, it has been fully optimized, etc. So processes are typically processes typically mature as they're being used, as they're being used in the industry, as they're being used by the firm, and so on. So level 0 is the level of the least sophistication, because there we face a lack of any basic capability. We essentially have uh, we essentially have no process available, and it's basically the absence of any processes situated at level 0. Level 1 is the next level. That means that the process is more or less achieves its purpose through the application of an incomplete set of activities. All right, so it's incomplete because these activities are characterized as initial or intuitive. It's not very well organized. And you will see that as you climb up this ladder, the process become more and more sophisticated, more and more mature. So at level 2, we have the process achieve its purpose through the application of a basic but complete set of activities that can be characterized as performed. At level 3, we have the process that achieves its purpose in a much more mature and organized way using organizational infrastructure and assets. At level 4, the process achieves its purpose, is very well defined, and its performance is measured. Level 5 is the most mature, the most capable level of process maturity, and it means that the process achieves its purpose, is well defined, its performance is measured to improve the performance continuously as such, right? So these are the 5 levels that come with COBIT. Now, my thoughts on COBIT, it's very important. It's a very important IS governance framework, but and I'm going to be a little bit critical here, I think it's a huge consulting business that comes with it. It's actually tons of money that circulate to ensure this COBOT, to ensure this COBIT, to ensure this, but also COSO and SOX compliance. But I think personally that COBIT is overly complex. It's too rigid and it's too formalized. I mean, if you read the document, which I did to prepare this lecture, I mean, it's a huge document. It's very complex. It has lots of specific terms which are often not well defined, and I think it's sometimes even hard for firms to comply with COBIT or to implement COBIT because they don't know what they should be implementing, right? And I think it turns IT governance into somewhat of a black monster. And I think it also, and it's a very thin line you're walking on here, because if you start to overly control people, then you start refraining people from doing what they like to do, or from doing what they're good at. And that's also something that we should consider. If you control people too much, it may create an adverse effect upon their productivity. All right. And I fear that if I look at many industries, many companies nowadays that implement these SOX, these COSO and COBIT standards, I fear that it creates a very bad impact on people, because it's not fun to work in a firm where you're constantly being controlled, right? Obviously, there should be mechanisms of control, but being constantly controlled and inspected is not something that is a good thing, I think, and that's something that we should be very careful about. And that's why I sometimes say, like, the US Navy in 1960, to operate and to define its processes, it used the so-called KISS principle: keep it simple and stupid. If there's too much complexity, it won't work, right? The KISS principle says keep it simple, stupid, right? Such that we rely on simple principles that work instead of making things unnecessarily complex. I think it's a very important principle which is lacking in today's business environment. I think in today's business environment, I think personally there's too much control going on. Conclusion. So we started this chapter, or we started this part C of this chapter with some recent bankruptcies like Parmalat, like Enron, like the credit crisis and the Societe Generale, Rock Trader, remember? And we said that we needed governance and internal control. We then moved on to the Sarbanes-Oxley Act, which was one act that was passed by the US Senate to enforce that. We discussed the COSO internal control integrated framework, and we basically said that IT plays a fundamental role in setting up, there's a typo there, setting up governance and internal control frameworks. We then discussed the COBIT framework as an IT governance framework, which kind of provides us with practical guidelines for achieving governance and internal control by means of IT technology. Um, Nowadays, there are many professional guidelines and frameworks available. I think there are too many available, right? It's as an organization, if you want to comply with all these principles, I mean, it's an ongoing challenge. It costs tons amount of money. And my critical thought on it is that there are just too many. It's just too complex to keep your IT sometimes even flexible and highly competitive. And many of these frameworks have been developed by professional certification organizations like ISACA, as I mentioned. So I hereby wish to conclude this part in chapter.